Welcome back to FinTalk, brought to you by Vermeer. Here we discuss pressing topics in fintech, regtech, covering regulatory, collateral and digital across banking and insurance and finance. Vermeer has been proud to deliver innovative software solutions in the industry with stability and cost efficiency for our global roster of clients. With over 20 years of trusted transformation in finance and insurance, we're bringing industry's top expertise to FinTalk. I'm Gerald Akhtar, and I'll be your host for this podcast. Welcome back to FinTalk. Thank you, Enrico, for joining me again. We'll have to give you a badge. There's a badge. I'm sure you know. Do you remember the Blue Peter badges?
Yes.
I have to get one of those made, won't we? So,
Thank you.
No, thank you for coming back. And I know the reason for coming back is the PRA released the first part of the near final rules for Basel, and we say near final. That's very important.
Yes, they are still keeping the door open for last minute changes, and there's still a couple of items that have a consultation running. So they are still evaluating the responses that they are getting. But it was a nice Christmas gift, I have to say.
Yeah, it was, wasn't it?
Yeah.
It wasn't just one paper. I mean, they dropped the strong and simple first regime anyway, and that was another kind of a little gift. It came a couple at once, was it? A bit like a London bus.
Yeah, they wanted to give a reading list for Christmas to people in this industry.
Yeah, let them sleep in some way.
Yes.
So last time you were on here, we spoke about the CP to do with this paper that got released. Any major changes that you've seen come out of it from the CP to what it is now?
Nothing groundbreaking. The only change that I would say was more of a confirmation rather than a change, which is relevant for everyone who's considering the implementation, is that whilst the rules, the principles are broadly speaking more in line or closer to the EBA implementation of the rules rather than the US version of the rules that was published at the end of the summer, they have espoused the implementation date defined by the US. So rules closer to Europe, but implementation date closer, same as effectively as the US. So they've tried to strike a balance, I would say. But in terms of actual requirements or regulation changes, there's, I would say, more clarification of points that were left open in the consultation paper rather than new items.
Yeah. And we've got to be aware that it's a near final rule. So there's definitely going to be more amendments as we go through this process now. You'll see, so we had a look and we saw some stuff around the CVA and the option to kind of not include the new exposure classes and things like that. So they put some kind of linear adjustment into that.
There's the one that you just mentioned on CVA. The other one that is worth mentioning is on the internal model approach for market risk. So on the most advanced between the three option of calculation methodology that is available, what the PRA is saying, there is an optionality to include the desks that have not been approved so they are not meeting the requirement yet for inclusion in the model. They can be included from a capital perspective up to 2026. So there's a sort of ease-in period in order to facilitate the inclusion of these desks from a capital perspective, mindful of the fact that all in all, we've known FRTB for a good 10 years now, but the actual final rules from the regulators are coming very close to the deadline, to the go live deadline. And so they are recognizing this and giving it, wherever possible, they are allowing a little bit more leeway in terms of these opportunities. And I would say comparing the three macro regimes, so comparing US rules, EU rules, and UK, the PRA seems to be seems to have taken the most pragmatic approach. So giving a little bit more leeway, even in terms of what is required, for example, for an application, a regulatory application, the threshold in terms of extent of the evidence that needs to be provided seems to be a little bit lower than what requested by other regulators.
Yeah. I mean, it allows for competition as well, isn't it? Aligning the dates and everything with the US.
Yes. It's born from a desire to not create too much of a difference with banks operating in the European Union, because this would create arbitrage opportunities. At the same time, it keeps the date consistent with the US, mindful that especially here in London, we have a lot of large US banks with a significant presence. So trying to not create too much of internal divergence there.
Yeah. Just to move on to talking about the euro, we had only recently on the 11th of January, the EU now dropped their first release on the market risk and FRTB.
Yes, so they dropped just before Christmas. They dropped as well a revised version of the rules. But then, as you said, in January they revised, and this is more important in a sense from a reporting perspective. They dropped the regulatory technical standard that defines the reporting requirements. So what we've seen there, and it's interesting because probably gives an indication also of where the PRA will move towards. We've seen what I cannot call other than an explosion in the volume and detail of the information that has to be disclosed. So we have a lot more templates than not only what is in the current framework that banks are still using today, but also compared to what was anticipated in the previous version of the technical standard.
So yeah, it's a lot of change in the euro.
Yes, we have in total market risk will go from 6 templates, as it is the case today, to a total of up to 28 templates. Again, which templates need to be reported is dependent on the product scope, on the type of calculation, and on the model approvals. But yeah up to 28.
That's going to be a significant change.
It's going to be a significant change. What is interesting is that in addition to disclosures on the specific calculations, we now have, I think for the first time, certainly within the capital framework, we have templates where banks have to justify, and if you think about it, it makes sense thinking about the underpinnings or the foundation of FRTB, but banks will have to report also on the reclassification of desks and positions. So when a position moves, for example, from being classified from the banking to the trading book or vice versa, banks will have to justify a report on a quarterly basis on this information.
Yeah, there's a lot more scrutiny now.
Yes, and the question will be, what will the regulator do with this data? We are seeing in general there's a lot more across the board, not limited only to the capital framework, but like regulators are increasingly asking for more detailed, more granular information. The question will be for banks understanding how this data is used, right? And in the reviews that no doubt will the PRA will start making once the go live data is passed. It will be interesting to understand which kind of conclusions are derived from the data and which kind of questions banks be asked.
Yeah, and data with the regulators is always a big topic, but we see that in the APAC region, the GDR reporting, we see transformer data collection here.
Yes.
We're seeing DORA in Europe as well. It's all kind of moving into that granular data reporting.
It's moving to that area, and it's moving to a direction that in a way was anticipated by the US. If you think about the format of most of the templates in the Y9C and Y14Q report, those kind of reports compared to the core that everyone is familiar with here in Europe are a lot more granular, a lot more akin to a data dumps rather than summary of calculations, right? And the Federal Reserve has made no mystery that they use this data to perform analysis internally and infer their own assumptions on the evolution of capital or the modeling that the bank has implemented. And they use this data to challenge then banks. So definitely it seems like there's a movement towards this approach even here and in APAC.
Yeah, and it's slowly evolving and it's starting to grab now more attention as we go through.
Yes, and it's an incentive for banks or a driver for banks to get their house in order in terms of data quality, in terms of availability of reference data. There's all those themes that we've heard and mentioned for a long time, but now we are seeing that within a new coherent framework that is represented by Basel 3.1, the regulators are actually putting this into practice and showing us where they are heading.
Yeah, and it's kind of refreshing. I mean, yeah, like you say, we've spoken about it many times, right? This the same theme that goes in again. And there's only recently the Dear CEO letter that the PRA just
Yes.
released as well.
Yeah.
Again, it just feels like a summary of the last two Dear CEO letters, and just
It is, but the reason why the letter is structured as it is because effectively from the reviews from the Section 166 that have been carried out, the one of the constant themes was the data is not accurate, and like the reference data is not accurate, and therefore if the inputs are not correct, then the output of capital can only be incorrect.
yeah, and that's just a common theme. It's going to keep going, and getting house in order is now
Yes,
paramount.
it's paramount. It represents from what I'm seeing in the market, it represents an ever growing component of implementation projects, in implementation initiatives. A consistent part of the budget is focused on improving the data, getting the data right, or sourcing the data that until today we haven't had in the organization, and we had to make do. Nowadays, with the explosion even in volume of the calculations, because if we talk about the FRTB, for example, it's a lot more granular, it's a lot more data intensive than the framework that have preceded it. It becomes impossible to make do with the data you have.
Yeah, and we talk about calculations and stuff. I want to bring this back to last time we spoke about the approaches around market risk. I know we've,
Yes.
from a vendor point of view and from a consultant point of view, spoken to your clients and we spoke to our clients. There's still clarity required around, okay, what is it? What approach are we going to take? We're currently on this approach, or should we go on a standard approach, or are we going on the advanced simplified approach? Where is that now kind of falling? Are people just saying, look, we know what we're doing, why change it? Just do what we continue doing.
We well, let's try and summarize it quickly. There's three approaches possible. The first one is the simplified standardized approach, which will be applicable from the first in the UK from the 1st of July 2025. It only applies to entities with very small and very simple training books. So there's specific quantitative requirement, both quantitative and qualitative requirements, defining whether an entity can apply this methodology, which is very similar, almost like largely unchanged from the current standardized approach, which uses a combination of notional and sensitivities to capture risk positions. This methodology, as I said, it's only applicable in very limited circumstances where the regulator wants the majority of firms to be on is on the second methodology, which is the alternative standardized approach. Effectively, it's going to be the baseline standardized approach that most firms will adopt. This is quite a complex calculation, to be perfectly honest. It aims to capture in a much more granular and accurate way risk profiles of positions that are more complex than a simple portfolio used, for example, for hedging interest rate or FX risk. And it split itself into three components, three calculations based on the sensitivity, so aimed at capturing the risk profile of positions. A default risk charge, which is used for capturing, as the name suggests, the default risk of both credit and equity positions. And then there's a final catch-all calculation, which is the residual risk add-on, which aims to capture products which have either a complex payoff profile, so I'm thinking your binary options or options with specific features, or instruments which have exotic underlying, so whether derivatives, crypto, or other non-standard underlyings. On top of this second methodology, so on top of the alternative standardized approach, you have alternative internal model approach, which is an evolution of the current internal model approach, what normally people know, generally speaking, as the VAR calculation. The VAR measure is replaced in this approach, which is, again, a lot more complex. And what the regulators have done compared to the current regime is they've increased the bar in terms of the requirements, the complexity, and the data that is required in order to be eligible for application of this model. And they do that on a desk-by-desk level. So there's very complex requirements on the eligibility of each desk and the eligibility of the entity as a whole for this methodology. But what is key to stress is that both for what we are seeing in the industry, both the alternative standardized approach and the alternative internal model approach at the moment, if properly implemented, and we can discuss on what if properly implemented, or like let's rather say after a period of fine-tuning to really iron out and perfect how the calculation is implemented, how the reference data is used, they are not leading to the significant capital increases that were originally anticipated. Like if you think about like a couple of years ago, people were talking about the 40 to 60% increase in RWAs. That is not the case. There are some increases, but they are not as significant.
And for all these approaches, does the firm need to apply for permissions?
So there is no application for the simplified standardized approach. There is a requirement. Firms have a certain degree of optionality in the alternative standardized approach for treatment of certain elements for which they need permission from the regulator. So there's many applications. And then there's clearly an extensive application required for the alternative internal model approach.
Yeah. But are you seeing firms now starting to go down, we're thinking of going down this route. Actually, now, no, we're going to go down.
Not so much a change in strategy, rather an effect or an impact on the timeline. So everyone will have, putting aside for a second firms which will be on the simplified standardized approach, every firm that will use the internal model approach will likely have to build, or will have to build also the capability to report using the alternative standardized approach, because of the fallback impact on each desk that doesn't meet the requirement. But in general, firms are working at the moment. They are mostly working on the alternative standardized approach. What we are seeing and what we've seen in the last year, not really affected by so much by the move in the shift in the go live date or by the clarification in the latest publications. But what we've seen is fewer banks that today have internal model approval are thinking of implementing the alternative internal model approach, because this requires a new application, even if they are already approved under the current framework, and it's a quite expensive process, and it's also quite cumbersome in terms of implementation. So what we've seen is a little bit of kicking the can down the road. So maybe banks that thought of going live with the calculation maybe in 2025, 2026 are now saying 2027, 2028.
Okay. So what's your advice to firms now that the final paper is here?
Now that the final paper is here, I think the advice, generally speaking, hasn't changed. Try to understand the rules and understand what the impact on your business will be. As we discussed, there are businesses more impacted than others, and so having a clear understanding of the impact on the calculation that this calculation will have on capital and on the various businesses is key. And then if the process for implementing these calculations hasn't started, the time to act is now, really, because if you think of it, there's 18 months roughly left. And in my experience, especially if we are talking about alternative standardized approach and up, 18 months is literally the bare minimum that will be needed for implementation.
Yeah, that's going to fly by, right? If you look at year end, quarter end.
Yes, especially considering that most firms will want to have at least 3, if not 6 months of parallel run with the calculation to assess the impact and iron out those differences.
Yeah, and that's very similar to what we're seeing as well, is a 6-month lead time to be able to test and run and fine tune and get your house in order ultimately and meet all those requirements that the regulator keeps sending us. Are you expecting any more change to happen?
Not so much. I would say that the difference between the near final rules and final rules should be minimal, if non-existent. Of course, we've only seen the first half of the movie, so the market risk calculations are not operating in complete isolation. There is an impact on the CVA calculation, and the CVA calculation themselves are then linked to the counterparty credit risk calculation. So, and the PRA hasn't published that part of the Basel 3.1 framework. So still to be seen if there's any unforeseen impact or last minute change that links up these three calculations.
Yeah, I think that's been the issue is, from a tech point of view as well, when we try to build it, actually, they've still got some parts of the puzzle that's still quite not there. So it's, yes, we can build this bit, and then, yes, we've got to then wait until that final bit is there before we finalize and then move forward with that.
And I think that the pressure for you would be from the point of view of your client wanting the finished product as soon as possible.
Yeah, of course, that's always the problem, isn't it? But then we have the data issue, which is the other, which is kind of the kickback, isn't it?
Yes, the data issue and the reference data. That's the part that I find quite interesting. How banks, like, because of course it's not up to software provider like you to provide that kind of data. So it doesn't form part of the package, but it really is part of the package from the bank's perspective. And we are seeing a mix of internal and external solution being implemented or being developed for the provision of this data. So it's quite interesting how it's evolving. And in some aspects, the PRA themselves have clarified in the final rules that there's certain provisions there for the use of externally sourced reference data for the calculation. So this is included and acknowledged in a way by the regulator.
Yeah. So lastly, we spoke before, we've had this DSCO letters, data, house in order, referential data, I say test scripts, but I mean, test the scenarios that you want to build, right? I think that's the kind of message we're kind of coming across is you do your impact analysis. If you haven't done it, you got to do it. If you need to then apply for your permissions, you got to start applying, getting those in. Yes,
those are the key pillars, I would say. The only other element that I would probably mention is processing controls. That is another element that in the PRA reviews of market risk implementation historically has come out as one of the areas needing improvement. This is an opportunity for firms to in a certain way clean the slate, start afresh, but really requires thinking about how the interaction between the various teams, how the controls will be implemented, who will be responsible for the controls on data that comes from different areas, from different teams, and not always the finance team that usually is responsible for regulatory reporting is best suited or armed with all the tools in order to monitor the data accordingly.
Yeah, that's a good point. And it's now starting to become a collaboration between the risk teams and compliance teams, front office. Everyone now starts to get involved in providing that kind of process and controls and governance around it. Enrico, you mentioned movie. I know we spoke offline about Saltburn.
Yes.
Out of 10?
My personal rating would probably say 4 out of 10.
We won't give any spoilers away, but
no.
Excellent. Something to look forward to. Enrico, thank you so much for being back on this.
Thank you.
It's been an absolute pleasure.